Have you noticed prices rising on electronics, appliances, or vehicles recently? Now, that's not just inflation, it's the direct result of a $1 trillion disruption in how goods move around the world, and it's affecting your investments whether you realize it or not. Even if you don't directly own stocks, your retirement accounts, insurance premiums, and job security are all connected to this massive economic shift. Today's analysis breaks down exactly how these global changes are impacting your financial future and what you can do about it. But before we dive in, please subscribe to our channel, like this video, and turn on notifications to stay informed about our latest content. The tariff shockwave, mapping the initial market response. When President Trump's administration unveiled the April tariffs, Wall Street's reaction can only be described as a profound miscalculation. Major financial analysts initially projected minimal market adjustments, treating the tariffs as a minor economic speed bump rather than the seismic event they would become. This complacency quickly evaporated as the full scope of the policy became apparent. The tariff implementation followed a rapid escalation pattern. The administration first established a 10% baseline on nearly all foreign imports effective April 5, 2025. Just 4 days later, on April 9, they implemented targeted reciprocal tariffs against nations with the largest U.S. trade deficits. China received the harshest measures, a 104% tariff that eventually rose to 125%, while Cambodia faced 49% tariffs and Vietnam 46%. These actions, leveraging the International Emergency Economic Powers Act of 1977, immediately destabilized markets. The market response resembled a stone dropped in calm water, with ripples expanding outward. The initial splash came with the S&P 500 dropping 1.5% on implementation day. The ripples reached Asian markets with greater force. Hong Kong's Hang Seng fell 4%, Japan's Nikkei dropped 3%, and Australia's ASX 200 lost 2%. The Dow Jones and Nasdaq recorded similar declines. Technology companies proved particularly vulnerable due to their interconnected global supply networks. Apple, facing potential $40 billion 0 cents annual cost increases, saw its stock tumble 12% within days. Nvidia's shares plunged 15% as tariffs threatened component production critical for computing products. Amazon dropped 8% with 20% of its goods suddenly subject to higher costs. Market sentiment transformed from dismissiveness to alarm as theoretical economic models failed against physical trade realities. Ports and distribution centers became bottlenecked while companies scrambled to adapt. The true nature of the crisis emerged as investors watched fundamentally strong companies face existential challenges from supply chain exposure. Nike exemplified this vulnerability, with analysts projecting $30 0 cents, $40 0 cents price increases per shoe, causing a 20% stock decline. The crisis proved particularly devastating through its multidimensional impact. The tariff rates didn't merely increase costs incrementally, they created fundamental viability questions for established business models. Their timing during peak shipping season maximized disruption, while the targeting of intermediate goods created a cascading effect through complex supply networks that amplified economic damage beyond most projections. Adaptation and aftershocks, corporate solutions, and market volatility. The cascading effect through supply networks didn't impact all companies equally. While some corporations watched their market value evaporate, others demonstrated remarkable resilience. This stark divergence revealed a new market reality where supply chain adaptability suddenly became as valuable as profitability itself, with stock performance serving as the ultimate scorecard. Corporate responses to the tariff shock varied dramatically. Manufacturers pursued different strategies. Some reshored production facilities, accepting higher labor costs to eliminate tariff exposure. Others maintained existing facilities but diversified supplier networks across multiple countries. The most risk-averse companies absorbed increased costs temporarily, hoping trade policies might reverse before implementing costly changes. These adaptation approaches created measurable financial impacts that investors quickly recognized. Companies demonstrating swift action saw their stock performance stabilize and recover, while those appearing paralyzed faced continued market punishment. This separation between winners and losers represented a fundamental reassessment of business models in the new trade environment. Pricing power emerged as a critical factor in weathering the storm. Industries with strong brand loyalty maintained margins despite higher input costs. For others in competitive consumer goods categories, absorbing costs became necessary to preserve market share, leading to significant margin compression. The automotive sector illustrated adaptation failure starkly. Stellantis' decision to lay off 900 workers and close multiple plants demonstrated the sector's vulnerability. Unable to reconfigure complex component networks quickly, automakers faced cost increases they couldn't pass to consumers, resulting in stock underperformance across the industry. Companies that had previously invested in supply chain flexibility gained significant advantages. Those with diversified manufacturing footprints and agile logistics networks maintained production continuity, while competitors struggled. Their stock performance reflected this operational advantage, recovering faster than industry averages. Investor priorities shifted in response to the crisis. Portfolio managers began evaluating companies based on supply chain resilience metrics previously receiving little attention. Geographic diversification, vertical integration capabilities, and domestic manufacturing capacity suddenly carried premium valuations. These corporate adaptations continue evolving today, with structural changes incompletely priced into many stocks. The market now distinguishes between companies capable of navigating disruption and those vulnerable to it, signaling a fundamental shift in how supply chain management influences long-term investment success. The new economic landscape, long-term market consequences. Those second-order effects are already here, quietly reshaping global economic alliances and trade flows. Markets face a critical question. Are we witnessing a temporary disruption or the first signs of a permanent economic realignment that will create decades of volatility? What's occurring beneath the surface is an acceleration of trends that began years ago but have now reached critical velocity. Imposed tariffs are forcing a fundamental regionalization of global trade. Consider electronics manufacturers who previously concentrated production in China. Many have already redistributed operations across Thailand, Malaysia, and Mexico, creating redundant supply networks that increase costs but reduce vulnerability. Companies are reassessing their entire supply chains, moving toward geographically diverse production systems. This strategic shift represents a structural transformation that most stock valuations don't yet reflect. Markets efficiently price immediate impacts but struggle with long horizon structural changes. Current stock prices capture the first wave of disruption while underestimating permanent alterations to global trade patterns. This gap between valuations and future reality suggests we're merely in the opening phase of a multi-year pricing adjustment. Like pieces shifting on a global chessboard, new economic alliances are forming in direct response to tariff pressures. Countries are diversifying their trading relationships toward more reliable partners. Vietnam exemplifies this shift. Having become a manufacturing alternative to China, it now faces steep tariffs itself, triggering another wave of geographic repositioning. The auto industry illustrates these transformations vividly. Confronting 25% tariffs on cars and components, companies have initiated layoffs, signaling deeper business model changes. The European Chamber in China warns these pressures necessitate a strategic rethink of business models and supply chains, resulting in higher operational costs and consumer prices. We're witnessing a competitive reshuffling that will determine market winners and losers for years. A company's national origin, production footprint, and exposure to specific tariff structures now directly impact its competitive standing. This explains why seemingly similar companies show markedly different performance. Some are structurally advantaged, while others face inherent obstacles. For investors, this means an extended period of above-average volatility as asset prices adjust to reflect a permanently altered global trade architecture. Conclusion. Financial institutions predict we're experiencing the beginning of a profound economic restructuring that will influence stock valuations for years. Major banks are advising clients to prioritize investments in companies with supply chain resilience and geographic diversity, determining tomorrow's market leaders. This transformation reshapes entire sectors as new investment criteria emerge. Staying informed about trade negotiations and geopolitical developments is essential for identifying value. What will be the next ripple in our global supply chain? For investors who adapt their analytical frameworks, these challenges offer unique opportunities in an altered global trade architecture. The time to prepare is now. What do you think? Let us know your thoughts in the comments below.